It didn't begin with a battle or a speech, but with a single televised announcement that quietly rewrote the rules of global power. A Sunday evening in August 1971, when President Richard Nixon looked into the camera and declared that the United States would no longer exchange dollars for gold. A decision that seemed technical at first, but in truth dismantled the world's financial gravity, untethering value from metal and tying it instead to belief, law, and American credibility. The gold window was closing, but something much more profitable was opening. For almost 3 decades after World War II, the Bretton Woods system had anchored the world's currencies to the US dollar and the dollar itself to gold at $35 per ounce. This arrangement made the United States the world's banker, the keeper of stability, but also the prisoner of its own promise. Every foreign central bank could demand gold in exchange for paper. As Europe and Japan rebuilt their industries, their trade surpluses piled up in dollars, and the Federal Reserve printed more to fund America's growing commitments abroad. The numbers stopped matching the vaults at Fort Knox. By the late 1960s, there were far more dollars overseas than there was gold in reserve to cover them. Foreign governments began to call America's bluff. France sent a warship to New York Harbor to collect its gold reserves. Britain filed requests for conversion. The illusion of convertibility cracked. Nixon faced a choice: drain the Treasury or break the promise. He chose to break it, not out of strength, but out of necessity. Yet history would remember it as a masterstroke. When Nixon spoke that night, he sold it as protection, a temporary suspension to defend the dollar against speculators. But the truth was radical. By severing gold from the dollar, America freed itself from limits. From that moment on, the value of the dollar would rest not on ounces of gold but on confidence, on faith that the U.S. government would honor its debt. Paper became power. At first, the world panicked. Economists feared inflation and chaos. European leaders called it the end of monetary discipline. But the opposite happened. Instead of rejecting the dollar, global markets absorbed it even deeper. Nations still needed a stable reference for trade, and no other currency carried the same trust, military backing, and liquidity. What was supposed to destroy the dollar instead made it indispensable. This was the quiet birth of a new export, not machinery, not oil, not technology, but the debt of the United States itself. Treasury bonds, once a domestic tool for financing wars or infrastructure, began to circulate globally like goods on ships. They offered safety, yield, and the prestige of American reliability. Foreign central banks began stockpiling them. Investors treated them as gold with interest, and the dollar transformed from a national currency into the bloodstream of global finance. By the end of the decade, America had discovered a paradoxical advantage. It could print the world's reserve currency, borrow in its own paper, and never truly go broke as long as others demanded dollars. The rest of the world worked, produced, and saved, while the U.S. could spend, issue debt, and watch that very debt become a product others competed to own. The gold era had ended, but a new empire began, one built not on mines and metal, but on signatures and screens, where value was conjured through confidence, and the most powerful export carried no weight at all. The genius of the American system was not that it survived without gold, but that it discovered how to turn absence into wealth. Once the dollar floated freely, Washington needed a mechanism to keep foreign nations tied to it. The answer arrived through oil, the one commodity every industrial economy could not live without. In 1973, as the oil crisis sent shockwaves through markets, the United States quietly brokered a deal with Saudi Arabia. The arrangement was simple but transformative. In exchange for American protection and military cooperation, Saudi oil would be sold only in U.S. dollars. Within a few years, every member of OPEC followed. This decision forced every country that needed oil, effectively the entire world, to hold dollars. To pay for energy, nations first had to buy America's currency, creating endless demand for it. The dollar, once backed by gold, was now backed by oil. But this wasn't just monetary diplomacy, it was engineering demand for American debt. When oil producers received mountains of dollars, they needed a place to store them safely and profitably. Washington provided the perfect instrument: U.S. Treasury bonds. These were no longer mere government IOUs. They had become the backbone of international reserves. Every barrel of oil sold in dollars generated a ripple of capital that flowed back into American securities. Economists would later call it petrodollar recycling, but in reality, it was the moment when borrowing itself became an export product. The cycle was elegant. The world paid for oil in dollars. Those dollars returned to America through the purchase of its debt. America in turn used that capital to fund its deficits, military spending, and domestic programs without draining its resources. It was a system that converted consumption into influence. Every time another nation bought U.S. bonds, it was, unknowingly, financing the continuation of American supremacy. By the 1980s, Wall Street had learned to weaponize this arrangement. The Reagan administration's tax cuts and defense buildup required massive borrowing, yet instead of punishing America with higher interest rates, global investors lined up to lend. Treasuries became the safest and most liquid asset in existence, a form of global collateral. Investment banks expanded the market even further, creating complex instruments built upon that debt, mortgage securities, corporate bonds, and derivatives that all depended, ultimately, on the credibility of the U.S. government. What once looked like a liability, a mountain of national debt, had become a commodity that could be bought, sold, and traded like oil itself. The financial markets learned to treat promises as products. Wall Street brokers weren't just selling stocks, they were selling slices of America's future obligations. Each Treasury auction was a reminder that America could print what others could only earn, and beneath it all was the illusion of balance. While foreign nations held U.S. bonds as assets, America held their trust as leverage. The Federal Reserve could adjust interest rates, print more dollars, or absorb foreign capital at will. Debt had become the hinge on which global trade moved. The higher America borrowed, the more instruments it created for others to buy, and the more the world's savings found their way back into its markets. The petrodollar system, the Treasury market, and the rise of financial derivatives were not separate phenomena. They were layers of one grand design to transform borrowing into profit. By exporting its debt, the United States exported its control. The rest of the world didn't just fund America's growth, it funded its authority. By the end of the 1980s, the United States no longer needed to produce more goods than its competitors. It only needed to produce more debt and convince the world that no one else could do it better. By the dawn of the 21st century, debt was no longer the shadow of prosperity. It was the engine of it. The United States had perfected a system where its deficits became someone else's savings, its borrowing became a global benchmark, and its promises were treated as assets. What began as a temporary suspension of gold in 1971 had evolved into an economic architecture so vast that even its critics were forced to participate. When the Federal Reserve lowered interest rates, investors from every continent shifted their money toward American bonds, seeking stability amid chaos. When crises erupted, Asia in 1997, the dot-com bust in 2000, the financial crash of 2008, capital fled back to the same place it feared. The irony was complete. The deeper the world's financial turmoil, the stronger the demand for U.S. debt became. Every panic reinforced the idea that America's IOUs were the safest thing money could buy. The digital era multiplied the illusion. Derivatives, credit swaps, and quantitative easing turned government promises into infinite financial products. What once represented a measure of obligation became a field of speculation. The world now traded not only in goods or currencies, but in layers of faith, each tied to the same foundation, the credibility of the United States Treasury. And while debt expanded, so did control. Nations that tried to decouple found themselves trapped. Their reserves, their trade settlements, and even their banking systems ran through the dollar. The architecture of global finance was built to ensure that opting out carried a cost higher than submission. The empire no longer needed soldiers to guard its borders. It needed bond buyers to guard its dominance. At home, the illusion grew comfortable. Americans learned to live through credit. Companies learned to grow through leverage. And Washington learned that the more it borrowed, the more the world demanded. Debt had ceased to be a burden. It had become a business model. Today, when you hold a dollar, you hold a claim on an empire made of promises. Every loan, every treasury bill, every mortgage-backed note is a thread in the same vast fabric that began when the world accepted belief over gold. It is a system of extraordinary beauty and danger, one that rewards confidence and punishes doubt. And as long as the world keeps believing, America will keep exporting its most profitable product, debt. If you found this story valuable, share it with others who love understanding the hidden gears of money and power. Like this video, subscribe to Financial Ripples, and help us keep uncovering how history still shapes the economy you live in.